But let's stay on the markets, shall we? Our next guest says stocks and bonds are pricing in a near-perfect scenario. Continued growth, little inflation impact from tariffs, coming rate cuts, and continued profits for corporate America. So what happens if one or more of these conditions aren't so perfect? Well, let's ask Unlimited CEO and CIO Bob Elliott. Bob, it's great to have you back on the show, and let's start right there. Why do you think we're priced to perfection here?
Well, if you take a look at what's priced in for equity earnings over the course of the next 12 to 18 months, you're looking at, double-digit or better earnings expectations. And bond yields at these levels continue to price in relatively strong growth over time and cuts in the short term. And so you put that together, and in order to achieve the outcomes expected across these markets, we're going to have almost a perfect combination of very strong growth and very little inflation that allow the Fed to ease, a combination of which is challenging to see when you see the hard data showing, in many ways, the opposite of those two trends.
So you don't think we're out of the woods in terms of tame inflation and tariff impact?
Well, if anything, we're just getting started with a tariff impact. And in fact, the collected tariff revenue, at least through May, which is when we have comprehensive data, was only about 8% when the announced policy rate on tariffs is 20% or higher. And so it's taking time for that tariff effect to actually even get implemented. There's a couple of structural reasons why that is. It takes time for the goods to come from offshore to onshore. And in addition, it takes time for the CBP to collect the actual revenues. And so you're talking about an actual tariff delay impact that could be, 3 or 6 months from the time of actual announcements. And so before it gets onto store shelves. And so we've got a ways to go before we can really say the U.S. economy is feeling the full effect of the tariff policies being announced.
So if you have money to put to work right now, what would you be doing with it? Would you be just keeping it in cash? Would you be taking some profits here and sitting in cash? Would you be investing it somewhere else?
Well, I think when we look at what's going on with equity markets at all-time highs, it's time to start to think about where can you get actual diversification. I think in many ways yesterday highlighted some of the risks that exist from a policy perspective when we saw both stocks and bonds go down when there was a threat that Chairman Powell would be removed. The one asset that showed real diversification power there was gold, and it's an asset that the vast majority of investors aren't holding in their portfolio.
Yeah, you've liked gold for a while. You continue to be a gold bug?
Well, I don't know about a bug, just a guy who looks at gold performance and sees that it's diversifying and continuing to drive, pretty good returns. And so I think the idea that, most investors are all in on bonds as their diversification tool, and, it's time to look to hard assets. Whether it's gold, maybe it's Bitcoin, if that's your interest, to help create a more diversified portfolio given all the uncertainties ahead.
In light of that, what do you think? We're expecting an executive order, potentially, perhaps at some point. Maybe it comes today, maybe it comes before the end of the week, regarding this idea of opening up 401ks and retirement funds to private markets. We know a lot of the alt firms have already been focusing a lot of attention on putting individuals into private markets. Do you think that would be a good way of diversifying?
That's about the last thing that investors really need. I mean, most of those alt programs are just different forms of being long only in equity-like risk, and they're just more illiquid and with higher fees. And investors don't need higher fees, and they don't need more long-only risk out there. They get plenty of that with the assets that they have available in their 401ks. What investors really need is they need diversifying strategies, so things that can go long and short if markets start to turn, or diversifying assets like gold in their portfolios. And so, it's in many ways just another money grab from the big private asset industry that, frankly, can't get anybody else to buy their assets given the illiquidity challenges that they've continued to face.